All right, so good morning and welcome to our August monthly event. We have the pleasure of learning from a distinguished group of commercial real estate lending professionals about the issues facing lenders today, both here in Atlanta and around the Southeast. We're excited to have everyone here this morning. But before we get started, I wanted to give you a preview of some of our upcoming events. On August 29th and 30th, CCIM will be an exhibitor and sponsor at the 2018 Southeast Accounting Show Conference at the Cobb Galleria. You can go to our website and register if you'd like to attend. We have our September chapter meeting will be held on September 6th. On September 12th, we'll host a happy hour event at the Five Seasons Brewery. This is an opportunity to network with CCIM students, chapter members, and many of our board of directors. In October 7th through 11th, we will be in Chicago at our CCIM annual conference. Our upcoming classes, we have a commercial real estate negotiations course that will be held on September 4th. We have our 101 class that's going to be held September 10th through the 13th. We have a Foundations for Success in Commercial Real Estate course that's going to be held on September 17th and 18th. We have our 103 course. It's going to be held October 22nd through October 25th. And our 104 course to round out the year will be November 5th through November 8th. So with that, I'd like to introduce our panelists this morning. First panelist is Lauren Pugliese.
Got it.
I got it, right? So Lauren is a director of real estate at Emeritus Investment Partners in Lincoln, Nebraska, where she oversees a portfolio of 70 commercial and multifamily properties nationwide with a gross asset value of $625 million. Emeritus Investment Partners is a registered investment advisor with more than $14 billion in assets under management for insurance companies, public and private pension funds, endowments, foundations, mutual funds, and high net worth individuals. Lauren has 13 years of experience in the real estate finance industry. In her role at Emeritus Investment Partners, Lauren focuses on portfolio management as well as originating joint venture investments and bridge loans. Prior to joining Emeritus, in 2012, Lauren was Vice President of Finance at Cypress Equities, which is a retail and mixed-use development firm in Dallas, Texas. Prior to Cypress, Lauren was an analyst at Archon Group, where she worked in a structured finance and portfolio management capacity on behalf of Goldman Sachs and the Whitehall Funds. Lauren is a graduate of Southern Methodist University with degrees in finance and Spanish. She lives in Lincoln, Nebraska with her husband, son, and 2 dogs. Lauren, so our next panelist is Chris Schweitzer. He's Senior VP and Commercial Real Estate Lending Manager in charge of BB&T's billion-dollar commercial real estate portfolio in Metro Atlanta. BB&T is one of the largest financial institutions in the country with approximately $220 billion in assets. BB&T is also one of the safest and well-capitalized of the nation's banks. Chris has 34 years of diverse commercial real estate finance experience in the Atlanta marketplace. Prior to joining BB&T in 2002, Chris's career included commercial mortgage loan originations and underwriting for Primary Capital Advisors, which is a commercial mortgage banking and a Freddie Mac lender, now part of Jones Lang LaSalle. Home Bank FSB, which is a thrift, now part of Wells Fargo. United Companies Life and Annuity, which is a life insurance company, and Bank South, which is a commercial bank, now part of Bank of America, as well as time with the FDIC's Resolution Trust during the savings and loan crisis. He is an honors graduate from the University of Virginia with a degree in economics and in history. Chris is an Atlanta native and is married with 2 sons. Chris? Last but not least, our third panelist is Matthew Rocco. He's the President and National Productions Manager at BB&T Greenbridge. Matt is he's a part of one of the nation's largest full-service commercial and multifamily mortgage banking firms. Matt's charged with all of Grambridge production and operations management and serves as an advisory member to many of the nation's largest institutional investors and capital correspondents. Prior to joining Grambridge in 1998, he was engaged in investment banking, bond issuance, underwriting, and real estate asset management. Matt is a member of the Grambridge Board of Managers and a member of the BB&T's senior leadership team. He's also a graduate of the University of Alabama. Matt's a licensed real estate broker, appraiser, ARM, and member of the Mortgage Banking Association. He's a CCIM member, NAIOP, ULI, Real Estate Investment Advisory Council, and the Board of Governors of the Real Estate Investment Society. Matt. I would also like to announce that BB&T Grambridge is not only a platinum sponsor with our chapter, but they have also one of their members of their team is also on our board of directors, Ms. Marcy Thomas, sitting in the back. And they have just signed on to be our keynote sponsor for the November Economic Forecast Luncheon. So let's give BB&T Grambridge a round. So with that, we can have the panelists come up front.
Thanks, everybody, for being here this morning. It's an honor and a pleasure to be here with you. Primarily, though, I want to set the stage by talking about, as Marcy described, and thank you very much to Marcy Thomas for really quarterbacking this initiative for us in partnership with CCIM. But we want to make this less about us and more about you. So with that said, and thank you for the introductions, I think that gives a varied background of the skills and expertise that are up here. But none of that really matters without fully leveraging what you bring to the table as well. And through partnership with each other, we'll be glad to answer any questions you have on the commercial real estate market space, the investment space with Lauren's background, not just as an institutional investor on the debt side, but also a JV equity investor as well, opportunistic funds and the like. And then, of course, Chris's varied background associated with all capital development and formation, from construction, interim, bridge, property assemblage, and everything in between. So we really do run the full gamut, and what we want to do is be a resource for you. It starts at the meeting today, but moreover, we'll make sure that Marcy shares with you all of our contact information. So from now and or into the future, if you or your client should have questions or need access or insights to what's happening in the secondary market from an investor's perspective, the primary market on the construction or debt origination side is associated with the banking communities, or what we do within Grambridge, part of BB&T on the capital market side, we're glad to provide that as well. So we're just going to start off with some softball questions between us. We rehearsed for seconds, so this is highly scripted, but it truly is about you. So please raise your hand. If you would, please stand up so everyone could hear the question, because we're here to serve you. So thanks very much for that. As we got started this morning, I came in from Boston, visiting with our team up there, and was just amazed at the vibrant economic community that exists in major metros like that. As I was going through, and I was on a ULI little panel, we were talking about what makes commercial real estate unique this time. I think in life, we tend to measure things by like our height, our weight, our birthdays, but in commercial real estate, we tend to focus on when was the last crash? Is it going to look like the next crash? When should we be scared, and everything else? But it was an interesting perspective, because what we have represented today, I think, is core to commercial real estate. And that means I think it's of utmost importance for you to understand, probably more important what's talked about in this room today than necessarily the conversations I had about New York, Boston, Los Angeles, San Francisco, where the highest cap rate I heard in this interaction was about 5%. And I remember one of the folks asking me the question said, they were also CCIM, and they said, we have this deal. It's really not that good a deal, but they're getting a great price on it. It's $188 million. It's an industrial deal, but we're selling it at a 505 cap. I'm thinking to myself, wow, that's not real world. But what real world means to us is probably what's of most interest to you. So I'll start off by saying, to Chris, representing capital formation on the banking side, the activity you see. And again, not necessarily in those gateway markets, but in a primary market, a market as important as North Georgia, Atlanta. What kind of activity do you see, and do you see now, that, if you will, concerns relative to who's being paid for the risks that they're taking? Do you see the appropriate alignment of debt and equity interests? That kind of stuff. So, Chris, I'll just turn it over to you to give us that perspective.
All right. Well, thank you. Well, first of all, there is a significant level of activity. I mean, all of the clients that we have that are in the commercial real estate business recognize that this is a good market time and a good time in the cycle, and that they're very anxious to find good property to buy. And fortunately, the cap rates are a little better than LA, but they're still historically low, and it makes it creates an opportunity for developers to pursue deals that would have a pretty low return on cost from a historical point of view, because they're very confident that they're still going to make a lot of money on with the low cap rates. And so the developers are very active, and on the investor side, there's probably a great degree of angst about can't find a good deal that's worth the price that's being going to be offered. But there's a lot of transactions that are taking place out there. There's no question about that. And the real estate community, who is, I think, sort of saying, well, we need to make hay while the sun is shining. I mean, the bankers are doing the same thing. We may have some concern about where the market is going in the future, but you still have to lend money. We still need loan growth, and so we're still going to be pursuing those kind of deals. And really, the nexus of that becomes at the point of equity, because how do you make these low cap rate deals work? How do you make them attractive to a risk-averse, stick-in-the-mud credit culture like a commercial bank? How do you do that? And the answer is equity. So we have see deals that have thin returns unless cap rates are very low a couple years from now. But how does we make that work from our point of view is more equity. But there's a lot going on.
And a lot of capital is fueling that interest for a whole bunch of reasons. We'll talk about that in a minute. But Chris, when is too much capital a bad thing now?
Well, so I think there's almost like a bubble in finance, but not in real estate. In other words, the fundamentals of real estate, of a new apartment construction deal, minus some submarkets which may be overbuilt, but there's still a lot of good deals out there. But where the problem is, of course, it's very self-serving, but where the problem is, there is too much money chasing it, and it takes a deal that is good for everybody, and the competitive environment is such that the deal you finally close on was just good enough. No longer do you feel, wow, we made a really good deal. And this is more maybe my more
not
personal.
being paid for that risk, if you will.
Yeah, it's the old no-brainer deals. There's still some really fine real estate deals, but by the time you're through negotiating all of the competition and winning the business, from the risk-reward standpoint to the lender, it's not that keen.
We talk about product scarcity, and Chris just highlighted, I think, what we're seeing nationwide. But Lauren, as you look, not only are you a large provider as an asset advisor to companies like ours for product distribution, our product is candidly capital. We provide capital so you and your clients can buy, leverage, and gain outsized returns over alternative fixed income investments. But Lauren's additional specialty is as an owner. So you're talking to one of the nation's largest owner investors, and she co-invests with customers just like you and the clients you represent. But how is product scarcity affecting you these days?
Sure. I would say it's been very difficult over the last 24 months to find transactions that, like you described, Chris, that really meet that risk-adjusted return requirement of ours. And we've always remained true to the concept, and it's certainly not rocket science, that you make your money on the buy. So if you overpay for something day one, it's very difficult to dig out of that hole. So we're very focused on acquisition basis, and what that's meant for us in recent times is that we haven't been as active as we would like to be in the acquisition space, because we really focus a lot on primary markets, but also secondary and to some extent tertiary locations. And that used to be a space where you would have smaller investors. You weren't competing with large institutional players, because while we are an institutional player, we kind of are in a smaller niche of 25 million and under. But we've started to see large institutions come into our space, and they, used to not touch deals of that size. So I think I just recently read there's about 250 billion of real estate private equity capital allocated to U.S. real estate that's currently in the market looking for deals. And it's really hard to compete with that, because those are groups that are very fee-based. They're driven by generating fee income, and so they're forced to place that capital. And I think that's really also created a bubble and made the market just extremely competitive. Overall, deal volume is down nationwide, but anytime a deal comes to the market, like I'm sure y'all are seeing, there is a ton of competition on every single transaction. And I keep thinking I can't be more amazed about the prices and cap rates that I'm seeing, but everyone just seems to outpace the next. So it's been tough, but we're still finding those transactions. For every deal I close, I probably look at another 15 that may or may not be something that we would be interested in pursuing, but very seldom are we successful in today's environment in bidding on something that's coming widely to the market, just because there are so many people that are getting aggressive with pricing.
It is interesting, as we had talked about the abundant amount of capital and the scarcity of product to invest in. Part of the backdrop there is commercial real estate is now at the forefront of investors' interest. It is 2 years ago introduced as a separate vertical in the financial sector under S&P, so it has its own listing, if you will. But moreover, its attractiveness to otherwise bond-like investors, and we were talking about this earlier today with Dollar Generals, they literally usurp the value you might get in a bond with more accretive returns and an equity kicker in the end. And yes, even in the middle, there's some tax-sheltered advantages as well. It's going to be interesting in this next iteration of our continued, I'll no longer call it a recovery, but flat-out expansion, however long that goes, what other forms of interest may be available for not just you and your clients, but for more people, and I would say for Main Street to participate into commercial real estate. I'm going to mention one here called the Delaware Statutory Trust. People familiar with that? By and large, very simply, it is really the child of the TIC, the tenant in common structure, where TICs were limited, DSTs up to 2,400 investors, and I know they manage it 12 in some, 2,100, 1,200 in one state, 2,400 in 48 other states, what have you. But it's going to, allow those that are not truly accredited investors, i.e. net worths of $1 million or more, to actually just invest $5,000, $10,000, $15,000, $20,000 or more into a transaction, and that gives them access to something that otherwise only very wealthy people could participate in. So as we look at that and the changing dynamics in ownership today, Chris, what would you say crowdfunding, DSTs, TICs, when these deals are coming in, how complex would it be for you to, still pick that right horse today? And what are some of the attributes, both in a package, a property, and a borrower you're looking for to make your investments, given how thin your margins are?
Well, we're going to start out every conversation with, whoa, stop telling me about the deal and tell me about yourself, about the sponsor or the banking. I mean, that's sort of no news to anybody, but banks are interested in the sponsor side primarily, and and then the collateral happens to be what it is, and that'll be underwritten in due course. But the main thing is, do we want to do business with you, with your client? That's the first starting point. And so a TIC is generally not going to fit that very well. I mean, because it's going to be a bunch of people. I mean, even under the Know Your Customer regulatory point of view, if a Delaware statutory trust has 2,000 owners, do you know how many pieces of paper we're going to have to fill out to do that? That's not going to be a good day for us. Now, one thing I will say is that our bank and banks in general, though, look at, say, on the other end of the spectrum, the single asset entity completely differently. For the general marketplace is going to say create an LLC that only owns that property and nothing else. But since we are interested in the sponsor and the sponsor cash flow and recourse and guarantees in most of our deals, that we like it when there's multi-asset. We like multi-asset entities, and so just from a structure point of view. I'll have to say that just in general, though, we have not found any deals that we've looked at that we've lost to a crowdfunding type of a structure.
Lauren, the basis of your investment is through partnership and with local boots on the ground. Tell us about what you're looking for, because you're not just providing the capital, but instead leveraging the expertise of another partner.
Sure. So, really what we're looking for in a partner is somebody that has that local market expertise. Based in Lincoln, Nebraska, and with a small team, we can't be experts in every single market across the country. Sometimes I like to think I am, but it's probably not true. But anyway, so we're looking for those groups that, really can provide that on-site, day-to-day expertise, be familiar with the property management components and leasing, and really somebody that is focused on maximizing the value of each investment. From a structure perspective, we generally require a sponsor to provide somewhere between 10 to 15% of the equity required on a transaction. So that's really a minimum for us to make sure that alignment of interest is part of the transaction. That's really critical from our standpoint when we're partnering with somebody. And we also look for somebody that has developed lasting relationships. They've partnered with other institutions or in the past, or if they haven't, that they have a group of friends, family, high net worth individuals that they've partnered with in the past and that are good relationships and can be resources for us to talk with and make sure that they have a solid track record. And, we'll run across a group that has had an issue in the past, and it's all about how they've dealt with it. So if somebody has had a past bankruptcy or they've given a deal back, we want to understand what that looked like and how they handled it. We always say that you learn who your partners are when times are tough. So that's really critical for us to understand and how they dealt with issues that may have arisen previously. And what Chris was describing before about structure and really how we're looking at DSTs and TICs in today's environment, that's not really a structure that's interesting to us as an investor. While we don't maintain any day-to-day controls, we do like to have approvals over major decisions like sales or refinances. So as an investor, we much prefer a limited liability company investment structure.
One of the things that we've seen post-Ice Age or during this recovery and now continued expansion in commercial real estate is a very intense regulatory environment. In fact, Graham Bridge alone, we have a conference room that's off to our side, and we host 27 audits a year. And I jokingly, whenever there's an audit in there, I'll walk through and say, okay, who's going to start paying rent? You drink all our coffee, using all the napkins and everything else, like what the heck? But it's some of that regulatory governance, although some of it arguably misplaced, and I will tell you, being under the microscope as we are and as an investment banking company and secondary market leader, it does get intense, and sometimes it candidly gets silly, but it has prevented some of the unregulated, if you will, the non-bank or non-institutional investors from disrupting the marketplace. That when capital is completely unregulated, then kind of silly things really begin. Have you seen that change in any way? And I'll start with you, Lauren. Have you seen folks, you talked about the intense competition, but have you seen folks just come into transactions and really just pay for things that they don't even know what they're getting? Is the stupid now creeping into today's world?
That's a great question, and I would answer that with a definite yes. I mean, we have certainly started to see that. An example, and very seldom do we participate in auction transactions just because it's difficult for us to get a high enough level of comfort with what we're getting with that process in place. But we decided to pursue an auction deal earlier this year in Cincinnati. It was an office building, had a lot of rollover, but it was a quality asset in a good location. And so we made a run at it, came up with the price that we were interested in, which was about $10 million. And somebody came in and ended up paying $15 million. And watching it on the auction platform, it was literally like, watching two people bid on something on eBay. It was like, who can...
Have folks seen that before? Have you been to it? Some of those back in the RTC, remember, it's a cattle auction.
Yeah.
Literally. If you turn on, I don't know what they auction today, cars or boats or whatever, when you go out there, they have an auctioneer and they get people going. Like some of when they raise money for charities,
Sure.
what Lauren's describing, it becomes contagious. And you see people even go beyond their thresholds, getting on multiple cell phones and whatever, asking for advice. But the fever, right?
Oh, absolutely. And from our perspective, when we saw the ultimate price on the transaction, that was what we had valued the property at once it was fully stabilized and had a solid rent roll. So how somebody could pay that for the asset up front, knowing the deferred maintenance that existed on the asset and the significant amount of rollover, we just couldn't make sense of it. So we're certainly starting to see that creep into the market. We've also seen an extraordinarily large number of debt funds in the market. I don't know if you guys have experienced that specifically in Atlanta, but there are groups that private equity groups that have funded and started to raise money for high yield debt funds, and so they're now entering the space, and that's something that really didn't exist previously. It's kind of, to some extent, I think, taken the place of what CMBS lenders used to do, but that's something that is going to be really interesting to watch play out, because there may be groups that don't necessarily have the experience from a life company standpoint. Because we have an in-house real estate team, we're not afraid to take something back if we have to. So whereas on the banking side, Chris is much more focused.
We don't want to.
Yeah, Chris is much more focused on the borrower, which we certainly are as well. That is very important to us. But we are also really focused on the underlying collateral. And what our debt producers are always asking me on the real estate side is, hey, Lauren, would you feel comfortable owning this asset at the basis of where my loan is going to be? And so we can opine on how we feel about that. But when you have these debt funds in the space that may or may not have that expertise, and they're inevitably lending on transitional investments that have, they're going into a bridge facility for a reason, it's going to be interesting to see how they are able to manage those deals if they have to take them back.
Any questions from the audience? Please jump in with anything, because I'll turn it over to Chris. You had mentioned earlier about there being, probably appropriate debt and equity splits right now. The equity truly taking that risk, and in Lauren's description right there, that may be some foolish equity, but there is fool's gold in every market. But Chris, with all this capital out there, do you see that migrating, where all of a sudden, to be competitive, the banking community is going to have to start doing the 70, 75, maybe pushing 80, and it might not be the 80 on something where it's really, when stabilized, to 65 or 70. It may be an 80 on a 70 or 75.
I don't actually really see it going that way. I mean, I really...
Is regulation some of that as well?
I think the regulatory piece of it is potentially a backstop, and referencing the debt funds. I mean, this is what I think the regulatory environment is attempting to manage that. But the problem, one of the problems, is that you're only managing the regulated institutions, which represent these days a much smaller fraction of the total debt being provided, and so the banks can do what their regulators tell them to do, but that isn't going to protect the market, because there's going to be capital markets vehicles and whatnot. But I think there are some strange regulatory thing. I mean, you have HVCRE and such like that. But like on the equity side, the HVCRE is 15% equity. Well, you know, no deals are being done at 15% equity anyway. So that the regulatory backstop is not come into play there. I think what's coming into play, why I don't think we're going to end up at 80% unless cap rates go back up so that becomes a more normalized debt yield in the underwriting. You know, it's the memory of the downturn that not enough people have retired during that period, and they remember it. So, and the fact that we're, you know, 8 years into a 5-year cycle, you know, there's legitimate concerns about everything is great, the fundamentals are great, the occupancies are great, but what decisions are we going to make today that 2 years from now we're going to regret? Because in 2006 we made some decisions that we didn't realize we were going to regret 2 years hence.
Any questions from the audience? You know, yes, please.
Indicators of a recession. Bank look at a broad array of things like too much cash, too deals, or high land prices, or
the R word. So let's just start, Lauren, with you. I mean, representing multiple insurance vehicles, as well as a primary investor yourself. What do you see? What is anything foreboding on the recession side, or do you anticipate or forecast that in your hold analysis?
You know, we're, as Chris mentioned, I mean, fundamentals are still so strong. And so from that standpoint, if a recession, well, when a recession happens, I don't see what it's going to be about real estate that would cause it. Certainly because of the strong fundamentals, leverage levels are not at the point that they were the last go around. People have been more conservative from that perspective. So I don't know if it's going to be real estate related, but it is something that we certainly look at. And that's why when we're underwriting a transaction, I think you have to be really careful at this point in the cycle about assuming there's going to be any sort of cap rate compression. So we're solely relying on NOI growth at this point to realize an increase in value as opposed to cap rate compression, because ultimately we're going to see rising interest rates. I think I read this morning that Jamie Dimon has announced that he thinks that interest rates are going to get to 5% here fairly quickly. And one thing that we are focused on is the potential of an inverted yield curve, because that usually is kind of a sign that maybe we're headed in the direction of a recession. So we are monitoring that closely in our underwriting by really looking at fundamentals as opposed to cap rate compression at this point.
I look at it every day. It's my job in determining, you know, we do loans of 5, 7, 10, 15, and 20 years. In fact, in our FHA product, we'll do a 40-year fixed. In that period of time, undoubtedly, there'll be 1, 2, or 3 recessions or setbacks, so we have to model it. What I see right now is very similar to what Lauren suggested there. There's enough discipline in place on the debt side, so to be clear, on the capital side of commercial real estate, that I don't see this being a real estate infused or amplified downturn. In fact, that without a black swan event in commercial real estate, the next question is, where is it going to come from? We, as the United States, rarely import recessions. We have a domestic economy. Our GDP is larger than many, even, G10 nations. So we have a unique benefit of the greatest land play the world has ever known, called the United States. Now, at this time, however, though, I do have concern. And it starts, Brexit, minor concern. I think Europe will figure out itself, but there's a lot more pain to go through in Europe. I seriously do believe trade barriers are bad. I truly believe that we could politically put ourselves in a ditch, and while we think, that's really good to get people reelected, that's actually really bad for Main Street. And for commercial real estate, it has an impact. Is it a big impact? No. The biggest impact, I think, is monetary policy, mostly associated with some of the fiscal or political considerations made or being made, but its impact with China. China reports, and they came out yesterday, 5.4% annualized growth. Here in the United States, we'd say that's almost hyperinflationary. Wow, that's terrific. We just hit 4% and people are doing cartwheels. Well, the reality is China is doing what China says that they're doing. And with an economy as large and interwoven with international markets as China is, if they're growing at 1% or they're really not growing, and we don't know the truth to that, and they stop buying or reinvesting in our treasuries or other debentures, that is a major problem. That is the financial disruption that I see. I think in and of itself, there's enough financial intermediation through world markets that's supporting our stock valuations, our very low bond yields, and what have you. But if we were to have either politically, socioeconomically, or domestically, particularly in China and India, a reversal in their true economies, that would reverberate throughout the economic world, and we would feel the pain. And it really would be ugly. Currency fluctuations, we would see that same today's intermediation become disintermediation. Capital would move out, go to safe havens, probably actually reinvest in the bond market, because we are the tallest economic midget in the world. And the world is a fragile place. There's a lot of things politically, socially, economically that are all here. The biggest one here in the United States, I would submit to you, is us, is the population. We're about to begin to retire baby boomers. And what does that mean? Where are they going to reinvest that capital? Are they going to go to fixed income? Not sure. Right now, bonds are pretty pricey. Are they going to go to the equity market? Well, the Dow's up in the last 52 weeks. I was looking at some stuff this morning. It's up over 4,500 points. Boy, is that a risk that you want to jump into right now at this stage in the cycle? This is where commercial real estate could benefit as a forefront investment for people. Well, there is always risk, and there's liquidity risk in commercial real estate. It's tangible. You get a tax benefit. You can touch it. You don't have to be a multimillionaire to invest in a DST or other type of syndicated equity ownership in an LLC that banks are still, comfortable with. So that's why I think commercial real estate now, its prices seem well supported. Yes, it's true. We have too many apartments in a lot of urban core markets. Industrial, candidly, I'll just tell you this. If you miss the internet boom like me, you can get the internet back end through industrial right now. The logistical industrial being built today is spectacular. These are intermodal distribution centers that will drive this economy and change the landscape, not just of retail, but of office uses and some other medical science uses for generations to come. So there's still parts to play in this, so I don't think this is a played out cycle, but I would be careful. At prices today, appreciation, as Lauren and Chris stated earlier, isn't going to come from compression in cap rates. It's likely not going to come from, if you will, rent growth, because we're probably maxed out on that. Amortization is your friend at this point in the cycle.
Matt, I would say about recession, we're going to go in a recession when everybody thinks we're going into a recession. Yeah. It's a very psychological thing, and all these types of panels, and if you list all the things you just listed that could go wrong, I think you're going to put us in one right now.
Yes, sir.
So here we are, we'll call it late cycle, and
two of the things that have been very apparent in this particular cycle. One has been leverage, which we've talked about. We haven't talked about debt service coverage, but there are very few lenders today that are not looking at debt service coverage as some form of default remedy. What other changes at this point in the life cycle do you think we're going to see? You mentioned amortization. Are we going to see shorter AMs? The other thing, yesterday I got my first commercial bank commitment that included obligatory impounds for tax and insurance, and the option to require reserves, which would be a CMBS vehicle rather than a commercial bank.
Sure. Yeah, that's a great question. Chris, what do you think about that?
Les, I think you're right that you're going to start to see some more structuring go into deals because the bankers want to make deals and the credit people want to stay out of trouble, and the only intersection there is to find a structure that both sides can live with, and I think you are going to see increasing amount of structural things like debt service coverage, covenants. We have occasionally started escrowing for taxes and insurance, but really, if for the most part, if we don't think you're going to pay your taxes and insurance, we're not comfortable in lending you the money to begin with. So that's not really a big thing, but some occasional situations where there's where the liability has been carved up in a certain way that's kind of makes people feel a little better about that. But I do think for us that the probably some situations where before we might have believed the business plan, we say you've got a good track record. We like what you've done. We agree that you can get better rents, higher rents, more occupancy, whatever the scenario is, and since you're guaranteeing the loan, we're in. I think now it's going to be more like, we'll lend you some now and some later, once you show it to us. But I do think there will be incrementally additional structuring aspects.
At this point in the cycle, mistakes are very, very expensive. In fact, we tend to do $5 to hundreds of millions of dollars in notional amount and loan amounts across the country, and we're exclusively non-recourse, so we never do recourse lending. We look to the property and its cash flows, but most of the time right now, we're not even measuring the loan to value because cap rates are so low. We're looking at a debt yield. We're looking at a coverage in place, and we're really testing those to what we think real rents are today, if they're not, in fact, what we think they are, or more importantly, stressing them during an economic downturn on kind of a net effective rent basis to see, can we still make this work when rents drop 10% and vacancy goes up 10%. Any other questions? Yes, sir.
The other are, aside from recession in my particular world, is retail. And in very generalized terms, I'd like to get the panel's sense of appetite for retail, given the fact that NOI and market rents right now are probably at their peak. Some might be a bit over. Over. Occupancy is struggling to maintain itself, and it seems to be a lot of speculative build going on continuously in retail. So I just wanted to get just a general sense of appetite from the debt service side, or debt, from the appetite of retail in general terms, and kind of what you see playing out. How many more nail salons and dry cleaners do we need?
Well, Chris and I never want to own real estate, so we'll turn this over to Lauren and ask her. She's the owner. Lauren, what do you think about retail?
So in general, real estate or retail is a pretty small percentage of our overall portfolio. It's about 13%. And really, from our perspective, when we're looking at a retail deal, if it's not grocery anchored, if it has a lot of junior box space, it's probably not something that we're going to be interested in. The caveat to that would be if something is a very well-located, service-oriented center, that's something that we'll still consider, because I think as real estate professionals, we know that there's always going to be a need for brick and mortar, as long as it's well-located and it's in that service-oriented industry, things that are more Amazon and internet-proof. But in general, we have because of the headline risk. I mean, it's something that, I don't know if you're seeing this at the bank, but when we're going to committee, it's the first thing that our board members are asking us. It's trickled down not only to just the general retail level, but it's even trickled into when we're doing an industrial transaction, our committee's wanting to know how much exposure we have to retail-like uses on the industrial side. So it's something that we're watching closely, but we still will entertain a retail deal to the extent that the dynamics make sense.
Likewise, BB&T is concerned about the direction of retail. I mean, we read the same articles and go to the same meetings that everybody else does. I think it's safe to say we have a strong appetite for grocery-anchored shopping centers, and then because we're an unusual bank for being such large size, but that we do such small loans as well, there's still a pretty good feel for the small unanchored strip centers, because those, you say, do we need another nail salon, etc. True enough, but at least Amazon isn't going to put the nail salon out of business. So some of those local service kind of things there still have legs if in the right location, right sponsor, good visibility, parking, all the fundamentals kind of thing. But, you know, this isn't any surprise. Indoor malls, no. A big box, yeah, I don't know. You know, it's just the bread and butter and things that we think are going to make it through the long haul, because there is a lot of concern about that.
And the secondary market feels exactly the way Chris does. If it's a proven deal, if it's got barriers to entry and stuff like that, there really, candidly, is a very strong appetite for those good deals, because we think those are the bellwethers that'll survive and perhaps even do reasonably well given other product types in a downturn. So, what other questions are out there from the audience, please?
Yep. So in general, when we're underwriting, we're very focused on what's happening in that submarket. So we're looking at rent comps, sales comps to really prove up the business plan on a specific transaction. On cap rates, like if any of you have ever done business with a life insurance company, we may be more conservative than a lot of other lending sources. But on cap rates, what we're underwriting is kind of a level that we feel is achievable in a normalized environment. So if we're currently at historical lows, we're going to underwrite something that is maybe more in line with the historical average for a deal. And, you know, in general, you know, we're looking at things like for expense comps and making sure that it's astonishing to me how many times I'll get in a model from a sponsor and, you know, it's showing 3.5% revenue growth, but expenses are only going to grow by 1.5%. So we're always making sure that everything is growing at the same level. So those are some of the things that we're specifically focused on when we're underwriting. And then on debt assumptions, just making sure that we're using an interest rate. If you're, depending on whether you're borrowing, if you're borrowing on a fixed rate basis or a floating rate basis, that we've included an appropriate interest rate throughout the expected hold term. And really when we're looking at something, so we're trying to underwrite depending on the risk profile and the dynamics of the transaction, we're trying to get to a leveraged internal rate of return of about 15% or higher. So I don't know, is this a new construction deal?
It is new construction, and so you said 15%?
Yeah, so for new
I'm still really shocked.
Yeah. And I think, I think for new construction, because of the risk associated with that, we probably would want to be more in the high teens, which would be in line with most institutional investors.
And what we'd want to talk to you about, and I know we need to wrap it up here, but is taxable and tax-exempt bonds. Particularly for workforce housing, that is a very efficient way to leverage working in partnership with a 501c3 or another even for-profit developer. The bond market is a serious option you should consider.
You guys are comfortable with when it comes to ESG?
Because it's pro forma, you know, it's different, so it's going to be elevated. But when you have elements of workforce housing, certificate, vouchers, or HAP contracts, we'll go right down to a 120. But for a retail component on the mixed-use side, that's like where we want to see 175 going in, because we know the retail rents are going to roll back. But we'd be glad to talk to you about, that in more detail and learn more about it, and if we could provide a recommendation, we'd be glad to do so. So thank you very much.
All right, thank you. Let's give Matt and Lauren and Chris a round. And I'd also like to thank BB&T Greenbridge for their tremendous support of our chapter, and I'd like to also thank you guys for being here this morning, and we will see you at our next chapter event on September 6th. I also want to thank Marcy, Kelly, and Michael for putting this wonderful program together. So thank you all, and enjoy the rest of the week.